5% isn't necessarily the boogeyman that I think the market initially thinks it is.
I don't think so. Thanks again, Romain, for having me on. And I think just to provide a little bit more perspective to that call of how we've been positioned here in portfolios and why I think Chairman Powell did a fantastic job, as usual, eloquently walking through what's happening in the bond market, how are they taking that information in, not only from the yields and the term premium coming back, et cetera, but also from the data dynamics or the economy that is proving to be quite a bit resilient. I think, but there was a very key message that he pointed out there was that they believe that rates at these levels, not only the front-end rates, but also the steepening that we've seen, the 10-year going and almost reaching 5% at this point, are quite a bit restrictive at this level. And they all need a little bit more time at these higher levels for those higher levels to seep into the economy. So yes, I think there is that frustration. I think that this restrictive policy is not yet showing up in the economic data. I think we saw it after the three big data prints after the last meeting as well. Sorry, please go ahead.
Well, I am curious, too, just about kind of what also has been driving the move. Jay Powell was asked about this earlier by David Weston, and he kind of said what a lot of folks who have come on our program have said, which is the idea that this is less about the Fed right now, at least what we're seeing on the long end of the curve, and much more about that term premium. And I'm wondering then, does that 5% threshold, or at least 5-ish% threshold, does that sort of become for the market, I guess, what becomes not just necessarily attractive, but I guess I'm just kind of avoiding the word here, but does that become the peak?
It does not necessarily. Again, this is where I think we have fair value models, quantitative models, and qualitative assessment of the market as well, that we come up with some fair values of that, not only just term premium, but actual nominal levels of 10-year. Maybe we are not at the peak, but this is the level that we think that we should be scaling into some more duration. Again, moving out from some of those front-end treasuries that we've been staying in. I think our biggest trade this year, not only being short the interest rate curve throughout the year, but also being in pretty significant amount of steepeners. 2 cents was one of our biggest trade this year, at least in the last 3.5 months that we've put on. But at this level, we do think that the term premium is starting to get at attractive levels. Has it peaked? Maybe not. And again, that is one more thing that he eloquently pointed out, that it is very tough in real time, especially when you have the fiscal situation deteriorating in an unsustainable path. That maybe there's a little bit more to go, but we find these levels attractive to start scaling into some positions.
Let's talk about this steepener a little bit more, because so far we've really been seeing this being driven rather by the long end, that bear steepening as the 10-year yield continues to rise. Do you think that that's going to be the dynamic that drives us back to positive territory? And does that matter necessarily from your standpoint?
I think you're referring to the bear steepening. Yes, absolutely. I think that is where our conviction level is, that term premium needs to had to correct from negative 110 basis points that we had seen 2 cents to at some point. And I think the Fed has very repeatedly over the last probably, I would say 3 months, over the last 2 meetings at least, and then right after the last meeting as well, concertedly come out and said that this is where we are going to be deliberately staying at these levels on the front end. So the front end seems to be very well anchored. Again, we are not expecting the front end to rally unless there is some disaster in the market, and in the crisis from the Middle East erupts to be a lot bigger and broader, if you will. So yes, the back end will be driving the shape of the curve a lot more at this point.
And Vishal, we don't have much time left, but I do want to talk a little bit more about term premium, because now if you look at certain measures, we are back in positive territory. And kind of wondering, why now? What finally put us back in positive territory?
I think the bigger question that we ask ourselves, and which is, again, one top of mind thing, apart from rates, Fed policy, and what does that implicate for rates and spreads, is the correlation between the risk assets versus the risk-free assets. Again, whether it's correlation between treasuries and spreads, whether it's correlation between equities and bond. And I think Chairman Powell again stole the thunder and very eloquently mentioned, I think that is one of the things that is driving this risk premium. At some point, that correlation becomes a lot more negative, and then investors require a lot less premium or that's where Romaine's question goes to, is like, at what point do we peak out on there? And that is where we think is an attractive time that the correlations are going to turn negative at this point.